We are now expecting potentially for rates to be cut even more slowly and maybe have few of those next year. So overall, the stance is becoming a little bit more hawkish, I'd say, just really because of the data that we're getting at the moment, partially because of the budget and what that changes will entail, but also partly because we are seeing more persistent wage growth and more persistent and slightly higher elevated inflation.
Yeah, the data flow has been hawkish for sure. Do you see the risk of a stagflation down the road in 2025 for the UK economy?
Well, it's a very good question, and we have had very weak GDP data recently. However, we are expecting next year to be relatively strong, partially because of government spending. We're going to see government ramping up spending quite substantially if they manage to go through the plans. And also, the flip side of the higher wage growth means that households have their real disposable, we feel like their disposable income rising over the next year. Interest rates are still going down. So all in all, we are expecting consumer spending to be relatively strong, and that's really a very strong component of overall GDP.
Do you have a neutral rate in mind? I mean, you know, folks at BlackRock, for example, talking about settling closer to 3% eventually, and that favors gilts. What is your projection in terms of the rates play here?
Well, we have had assessments post-COVID showing that the neutral rate is around 3. I think given the bias at the BOE and also given the fact that they will probably be concerned about inflation expectation for some time, it's more likely that the BOE will settle at around 3.25, maybe even 3.5, depending on the way they see expectations evolving.
Some are talking about this austerity budget or tax raising budget and how that is actually biting into especially the smaller players in the private sector. How much of a consideration should that be going into 2025?
Well, I think there's two things that we're going to see on the back of it. One is that it is quite likely that at least in the short term, companies will seek to pass on at least part of these costs or additional costs through higher prices, given the demand is generally relatively strong still. So that's why we are expecting inflation to be slightly higher in the short term. The other thing is that they may not hire as much next year, but unemployment is relatively tight. So what we do need is more people coming into the labor market. But it's not a question of trying to reduce the unemployment. So that would not necessarily have a lot of impact on demand as such.